Morning all. We're just waiting 2 minutes for more people to join and then we'll kick off. Thank you. Great. Good afternoon all. Thank you again for joining us for one of the Cresco webinars. We've made an incentive or plan to at least have one a month this year. I think we had 8 last year, so thank you for joining us. Today we're going to talk about more of a practical working session around the current Eskom retail tariff plan, working through the Eskom calculator. I'll go through the agenda shortly. We have another webinar on the 20th of March with the JSE on carbon, and then we have one on the 20th of April on decarbonisation. So we look forward to hopefully you'll join us for those. You don't have to take screenshots and everything. If you registered for the webinar, you will receive the recording link and the PowerPoint presentations from everyone off the back of that, but you're obviously welcome to do what you want from that point of view. Cool. Next slide, please. So I'm going to touch on how this all fits within the bigger picture. And for those of you who joined us last week on the SAWEM in-person workshop, unfortunately, there's a few duplicate slides, but hopefully for many of you, there'll be new ones. Shirley's going to touch on why there's these changes and what Eskom or NERSA has approved on the Eskom. I think Shirley was intimately involved initially, and so she has a good working knowledge. Enriko is going to talk about some of the views outside of just what was approved under the Eskom retail tariff plan. Cresco believes that there are more changes still to come, and this is just the beginning. And then Jon's going to walk us through a bit of a worked example and give you some financial outputs of what we see. We are doing a number of these sessions for clients, so the outputs here are sanitized, but for the detailed clients, we obviously will provide a megaflex table based on the various scenarios. Thank you. Okay, next slide, please. Next slide, please. So I think at a high level, I think that the key things that Cresco is looking for in 2025, and we did this slide in December, and now it was in the engineering news, is really what the impact of NYPD 6 will be. Cresco is doing some financial analysis on NYPD from first principles, and I don't think anyone would have guessed the 12.7%. In fact, I'm glad we hadn't done that presentation yet, otherwise we'd have a bit of egg on our face. But we are reworking what this actually will mean for Eskom, because I think we believe that Eskom needs more than that to survive, at least in a sustainable manner. The other one, which is today, is the Eskom retail tariff plan. The rest of the slides on that. I think the other bit that we're working on is an update on the load shedding scenarios, the demand supply map based on projects that now achieve financial close. We were involved in 5 projects last year on a private bilateral basis. We got financial close. There were a few other projects that got there. And we're hoping some of the aggregated deals will get to financial close. And what we are excited about is a lot of projects that have been in Excel for a number of years are now actually in construction. And some of the deals have even got to operations. So I think some of the Sasol deals have done. I understand some of the Richards Bay Minerals projects are hopefully there. So a very exciting time to be in there. The big other thing, which is not today's discussion, but I do touch on it, is the impact of the multi-market model. And last year, I think it was very much driven by Keith Bone from Eskom, who's doing a great job of trying to present what their view of the market is, workshops and PowerPoint, but we've seen a real increase in momentum in terms of interest in trying to understand the market, as well as impetus from the Eskom side and the regulator to get the market going. And we're conscious that we might not achieve all the timelines that are set in the PowerPoint slides, but there are certain parts of the market, specifically balancing, that we could already have in place. And that, I guess, talks to point number 4. We see balancing as a real opportunity for BESS, but also as a significant risk for large generators, and then also for non-dispatchable, large loads, as well as potentially non-dispatchable generators. And we're doing a fair bit of work around that. And the accuracy of forecasting, I think, is very much coming out to the side. And then the other bit there is a real concern. And we had an event at the Mining Indaba on gas. We had Total Matola speak. We had Transnet and Vopak speak. And these projects are progressing, but Cresco still has some serious concerns around large-scale gas generation being online in the timeline that is set. And that, I think, is linked to some of our longer-term load shedding scenarios, driven by different factors for what we experienced in February this year. Next slide, please. So we have, we did the view in May last year. We did one in November, the long-term view. We have some in we're redoing some now in March. And I think the bit that we are interested in is around what happens in 2028. And for us, that potentially is when we will have a partial market there. But what happens then from a tariff point of view is we also need Megaflex to be fully unbundled, and we'll have both regulated and unregulated tariffs. So the regulated tariffs will be as if you continue to buy from Eskom distribution through the current tariff structure, although the tariff structure needs to be materially changed. And then unregulated is really when you're a participant in the market. And a lot of the work we're trying to do at the moment is trying to understand how this will affect large loads and generators when we have this divergence going forward. Now, this presentation doesn't touch on that going forward, but if you are interested in some of our thinking, please reach out to us from that point of view. I think at a high level, our view is not materially changing in March this year. We still see a huge push for BESS. We do see some delayed renewable rollout, although we have had some good successes end of last year. I've mentioned large-scale gas generation only being really in place by 2030. And then the coal decommissioning, it's a little bit up in the air. EAFs have improved, but then certain times the older power stations are under pressure. So I think that's on our revised view. I think we might have a different view on the coal decommissioning, or more specifically, the EAFs that we project going forward for the current coal fleet. Next slide, please. So how does this fit within the type of work that Cresco is doing? So I mentioned the MYPD and long-term forecasting, specifically around we have a high, medium, and low road, and now we have a revised road based on the 12.7%. And then what happens to tariffs in 2028 when SAWEM is implemented? And the concept, if it happens in 28 or 29 or 27, I don't think that the date makes a huge difference to the thinking around how it's unbundled. The bulk of today's presentation is on the Eskom retail tariff plan. So we're doing this analysis. We have been doing this analysis for a number of clients for a while. We're happy to say that we sort of think we got it quite accurate for some of the scenarios we did to some clients last year, although the generator capacity charge is less than we have. But we've built more detailed scenarios and an easy-to-use tool to see what the impact is. The other bit that is creating some interest is how do we get value back into the renewable space, and specifically the value of carbon. And we had a workshop yesterday with a client in terms of carbon tax, the fact that currently in the Eskom in the NERSA approval of the Megaflex, there's no more carbon component. Where is that carbon component coming out? Will people be paying more under the carbon component? Where's the value of RECs? What's an IREC versus a ZA REC? What's the difference? And so we're doing a fair bit of work around that, because we're hoping that we will start seeing value of renewables back in the system to try and counter some of the impact of the Eskom retail tariff plan through valuing the carbon component. And then I've mentioned SAWEM, the Southern African Wholesale Energy Market, and the work that's been done from there. And if you are interested please send an email to Vumile on the registration, and we can send you a recording from last week's session in which Keith Bowen from Eskom Market Operator spoke, Alex Velekis from Bowman's, and then we had 4 different traders speaking about their view of the market, and hopefully you'll get some value from that. So thank you very much. Next slide, please. Now, I think that the key bit that on the SAWEM side and the linkage, and I'm going to repeat what I said in the earlier slide, so apologies, but in more detail, is we have last year where we sort of were trying to understand the market. This year, the impetus on the market has increased. So Eskom is currently engaging with many of the participants or stakeholders, provided public comments. We're expecting a revised market code in March, April going forward. And there's a fair bit that is in Eskom's control, and there's a fair bit that's sort of outside of Eskom's control and the thinking. And I think this is where the other stakeholders need to come in place. NERSA gets to get also involved a bit more in terms of where is the tariff going? What will Megaflex look like when the market is fully here? The unbundled components, where are components of the tariff sitting going into the market? And then what are some scenarios around the day ahead pricing? And this is outside of today's webinar, but that is definitely a lot of the thinking that a lot of our clients are starting to think about is they have a large amount of generation coming online based on these projects that I mentioned last year, or new projects behind the meter coming online, and how do they mitigate against the risk of the market or take advantage of the market, specifically through best strategies going forward. So this hopefully gives some context around where the webinar sits within the greater macroeconomic economy or energy value chain. Next slide, please. Now, in the market itself, a pretty complicated slide, lots going on. So we have the system operator that already exists and is doing a phenomenal job. We have market operations that also already exists, and I think since the early 2000s, they've actually been dispatching Eskom generators on a least cost basis in an unconstrained scenario. We know the last couple of years, it's been grab every electron that you can. And then we have a plan towards a day-ahead market, an intraday market. And what is very interesting out of this is going to be the balancing market around getting your accuracy of the forecasting, and then also around ancillary services. And I guess that's quite a big question around the tariff itself, because at the moment, ancillary services is a small amount and probably undercosted in the current tariff. We know new renewables, or leave it gas, will come at a much higher cost versus what's currently sitting in ancillary services in the Megaflex tariff structure. So we're trying to split out that in some of the analysis to try and truly value what would come from potentially best technologies. And then over time, we'll grow towards a capacity market and things like that. So this Eskom retail tariff plan for us is a sort of a 2 to 3 year window transition. I don't want to use the word transition phase. It has a number of definitions in South Africa across things, but during this interim phase, as the market comes out and the Eskom Megaflex tariff is further unbundled into its various components, and we start pushing towards at least each component of the tariff perhaps being more cost reflective, because that's definitely what I understand has not happened based on the fact that Eskom has consistently increased the components of the tariffs on an equal basis, or NERSA has approved the components for the last 10, 15 years going forward. So a lot happening, a few slides. Happy to unpack each of these in a bit more detail if you're interested. For many clients, we are spending a lot of time on this. So thank you very much. What I failed to mention, again, apologies, was that we were taking questions at the end of there, and if you could just put them in the chat, I'll be managing them accordingly. At the moment, I don't see any questions, except a lot of AI assistance coming in. So if there's any, put them in now, and we're trying to answer at the end. Otherwise, to the next presentation. Shirley? Next slide, please. Yeah, thank you.
Thank you, Rob, and good afternoon, everyone. So what I'm going to go through...
Can you pop on your camera? It's not there. Thank you. Thank you.
Thanks. Okay, yes. Good afternoon, everyone. So I'm going to just take you through, at a high level, the changes to the tariffs and how that will potentially impact, for example, wheeling deals. So the current Megaflex has time of use charges and distribution and transmission losses added to the energy rates. Eskom proposed updating with the latest costs, and as Rob said previously, all the rates have gone up with the tariff increases. and those tariff increases have been applied equally to everything. So it doesn't necessarily reflect the cost splits for generation, transmission, and distribution. So what also happened is that the energy charges were proposed to be unbundled into a generation capacity charge, a legacy charge, and the variable time of use charges. And that Eskom is proposed that the legacy charge would not be credited for wheeling. It would only be based on the variable time of use charges. And then there were changes to the peak and off-peak ratios, and loss factors were updated. So NERSA basically approved everything that Eskom submitted, except they were not happy with the generation capacity charge. It was based on 7% of Eskom generation costs, and NERSA said they wanted that to be reduced, the 7%. So the generation capacity charge was reduced by 80%. NERSA only wanted it to be 20% of the 7%. So this is what is important. It's not clear if this actually impacts the WEPS rate excluding losses, because of the reduction in the generation capacity charge has to be added to the time of use rates. Then transmission charges were updated with the latest costs. NERSA approved that. They approved the ancillary service charge. They approved the distribution network charges. They approved the subsidy charges, and that the affordability subsidy charge was removed from the wheeling credit, and that the retail charges were also updated based on the latest cost of supply. The important thing around this is that because there has that slight modification around the generation capacity charge, Eskom will have to recalculate all the rates and then submit them to the regulator for approval. So Eskom still has to go and submit its schedule of standard prices to the regulator, and added to that will then be the Eskom price increase. So hopefully that will be available in the Feb or middle March at the latest, because Eskom has to table in Parliament. Next slide.
So Shirley, I'm going to jump in here, and I know we always normally wait till the end, but you were involved in the 2022 application, which I understand NERSA didn't even bother to respond to. So this is not the first time this thing. Why do you think they approved basically everything this time except the really sensitive generator approach, generator capacity charge reduction? Is it the groundwork you did previously?
I think it was the groundwork, and so this was the third tariff plan that Eskom submitted, and this was the one that was approved. I can't talk why NERSA approved this one versus it didn't approve the others, except I think, you know, the industry is changing. Tariffs had to be increased. Tariffs had to be unbundled. Tariffs had to reflect generation, transmission, and distribution more accurately. The transmission license being given in 24 also meant that all these tariff rates needed to reflect the different components of the tariffs more accurately. So I think the big driver probably was the transmission license being given last year. Thanks.
Thank you.
Okay, so this is just going into what the changes were that were approved by the regulator. So Eskom's rationale is saying that the load profile has changed over the years, and that's the graph on the right-hand side. And because of that, the time of use periods needed to change. So, for example, you can see on a Sunday, there's still quite a peak, and Sunday currently is all off-peak. So Eskom wanted to introduce a standard period, and they also said that the evening peak was a bigger challenge. Therefore, they reduced the number of hours in the morning and increased the number of hours in the evening. The other thing that also needs to be noted is that there were ratio changes as well. So currently the peak to off-peak peaks, winter, summer off-peak is 1 to 8, and Eskom proposed to move it to 1 to 6. So that ratio change, plus the fact that the generator capacity charge was removed, well, pulled out, and the legacy charge was removed, overall, there's a reduction in the WEPS rate, and that will have an impact on wheeling transactions. So the structure and the rates are aligned with distribution's purchase costs from the NTCSA, and the rates, as I said, now exclude. So you can see just in the winter peak, the current 24-25 rate is R5.43, and it actually reduces to R4.78. As mentioned, the fact that the generator capacity charge, or 80% of it now, needs to go back into the energy rates, it's not clear if that's actually going to be added to the WEPS rate. I would suspect not, because Eskom doesn't want to credit capacity-related costs. Next slide. Then just on the generator capacity charge, the Eskom rationale for that is that because generation costs are largely fixed, and Eskom generation needs to provide a backup for whenever the sun's not shining or the wind's not blowing, or the customer's own generation fails or whatever, that backup cost needs to be converted into a fixed charge. And as it's said, it was based on 7% of generation costs, even though in reality more than probably 50% of Eskom generation costs are fixed. So this is really a signal for customers that lean on the system, but if you put all your fixed costs into variable charges, customers can avoid that, and then when they lean on the system, it creates subsidies to those customers that lean on the system. And it's based on, and by the way, if anybody's interested, Eskom has published their cost of supply methodology as well. So that's quite an interesting document which went with the Eskom tariff plan. Then the legacy charge, and this is also included in the market code, that, excuse me, that the Section 34 purchases of energy need to be ring-fenced and recovered through a separate legacy charge. And that legacy charge is also not avoided by a wheeling transaction, because it should be a socialized costs. So the energy charges have now been split into 3 components: the generation capacity charge, the legacy charge, and the time of use energy charges. And as mentioned, NERSA has recommended that approved, made a decision rather, that the generation capacity charge should be 20% of what Eskom actually submitted in its tariff plan. Next slide. So these are the changes that impact wheeling. So the unbundling into those 3 components, it actually reduces the wholesale rates and therefore the WEPS credit that customers get when they're wheeling. This is before the price increase, so the price increase would obviously increase that again. Then the time of use ratios themselves also impact the benefit customers might receive due to a wheeling transaction. And the removal of the affordability subsidy from the WEPS credit mechanism is an additional factor. Now, what is important is these impact wheeling transactions, but have much less of an impact if you have beyond the meter generation. So what are all the things that are impacting it? We got the tariff increases, the time of use period changes, the ratio changes, the introduction of this generation capacity charge and the legacy charge, the removal of the affordability subsidy, and also increases to use of system charges that will be coming. So the impact on customers just depends really on their load profile, if they're going to have battery storage or not. Some will have negative impacts and others have positive. And just as a note, that this WEPS credit mechanism, when the wholesale market is introduced, is going to have to change in separating use of system from energy purchases, because the avoided cost of Eskom distribution is not necessarily going to be the WEPS rate. It'll be also what they are purchasing from the market. Next slide. So what are sort of the future view on increases? We know there's going to be future tariff increases. NERSA has already made a decision for the MYPD6, and then beyond that, and then how those that whole MYPD process is going to be dealt with when there's the wholesale market. Then the generation capacity charge and legacy charge at a wholesale level. It's possible that the legacy charge could be converted to a fixed charge. This is Cresco's views on this, because beyond the meter, customers can avoid paying this legacy charge. The generation capacity charge may increase. So already, you know, Eskom wanted at least 7%. That might increase over time, depending on what the regulator will allow. And then the transmission use of system and ancillary service charges increasing. So if you've looked at the MYPD6 for transmission, you will see a quite significant asset return on assets and so on that have been added to transmission. Then future Eskom structural changes to the tariffs. Eskom might, because they are going to be implementing the NERSA decision for 1 April. We did not hear any delay of that. So we're assuming that's going to be applicable for 1 April 25. But it's based on the 24-25 MYPD decision. So Eskom might want to update further, aligned to the MYPD6, so a new cost of supply and new retail tariff submitted. Maybe there's going to be further unbundling of the tariffs, also differential price increases. Currently, the price increases across the board are, again, going to be the same for all the rates. Maybe in future, distribution, transmission, and generation would see different increases, and the rates themselves see different increases. Also, time of use periods and rates will be aligned to wholesale tariff changes and eventually the market prices. So that could also there could also be changes there. Generator use of system charges are going to need to be revised. They are based on 2011 methodology. That methodology is no longer applicable. Eskom could be wanting to increase the fixed charges component of network charges, so that could also impact customers. And then wheeling and net billing recons moving from monthly to hourly. Then the impact of the wholesale market still needs to be properly unpacked. It's not clear what this is going to mean for bilateral trade on the WEPS credit. I just mentioned that previously that this whole WEPS credit mechanism is going to have to be revised. And it needs fully unbundled tariffs. The retail charges, how they're going to be determined. And there we are actually talking about at the retail level, if Eskom distribution is buying at the wholesale price, how they're going to be determining the retail tariffs, and things like balancing charges that are going to be implemented. I think that's my last slide.
Cool. Shirley, there's 2 questions from the group. Well, a few questions from the group, but we'll answer some of them. So the one is around, I think we've answered what the legacy charge is. So that's the REAP projects there. But I think the other question was around, just to confirm, and you did say it, but just for clarity, is that my understanding is a embedded or behind the meter project will avoid the legacy charge under the current retail tariff.
And the affordability subsidy charge and the electrification rural subsidy charge and ancillary services charges. So anything that's based on cents per kilowatt hour will be avoided. Yeah.
Correct. And that definitely comes out of our analysis, and it's not part of today's presentation, shows the significant benefit from behind the meter projects versus wheeling if you have the same cost of generation and load. So agreed. Then just a high level one, I mean, we talk about all these changes happening over time, and on the market code, the idea is to get the capacity component of the Eskom cost base across its various structures up to 30%. And we've seen now that NERSA's pushed back on that. I assume that is part of the thinking over time, that eventually Eskom will start continuously asking for that, but perhaps on an unbundled tariff basis to eventually get to what they think is the fair component of a fixed charge. Is that your view too?
Yeah, definitely. Because, I mean, how it works is that the NTCSA or the market operator pays generation a capacity charge. What they pay as a capacity charge is not the same as what they charge Eskom distribution as a capacity charge. So over time, there needs to be some kind of alignment with that, even though I don't believe it'll ever go to the same value as what they are paying generation.
No. Cool. Thank you. And then there were a few other questions, and I'll just make some comments on them. So it's around non-paying customers subsidizing, or paying customers subsidizing non-paying customers. This obviously is not part of the Eskom retail tariff plan. And unfortunately, under NYPD methodology, there is an allowance for bad debts, but working capital, maybe not bad debts, but the impact from a cash flow point of view is definitely understated relative to the NYPD process. Unfortunately, the NERSA thinking doesn't actually allow for cash flow related in terms. I don't know if you have any comments on that.
I'm just saying NERSA removed all bad debt allowance from the NYPD 6 decision.
Yeah.
So that's a country risk. It's a country risk. Because, as you say, it's cash flow. Where does Eskom get the money to cover this cost? Yeah.
And then there's a comment, in future is WEPS in future. I assume that is, what will WEPS look like in the future? And I think the answer, you've mentioned that already, is WEPS is going to completely be restructured. Never mind the fact that the value is going to reduce in that, but WEPS will look very different. And therefore, a lot of the bilateral PPAs that talk to a WEPS credit mechanism will have to be changed. And I guess that sits under the change in law clause.
Well, again, that's if you separate your use of system from what you purchase from the retailer, the impact, if all things being equal, you'll get the same benefits. But of course, it's Eskom distribution or other distributors that are going to be buying from the wholesale market that will have to deal with how they will be dealing with any credit mechanism. So what I'm trying to explain is, if you are buying through a bilateral and you're buying from Eskom distribution, you will end up getting a bill for energy only for what you buy from Eskom distribution, but you will pay wheeling charges on all the energy wheeled. So you'll get sort of two bills, and that will deal with, take away the need to do a credit mechanism.
And I guess we'll slowly start moving towards what Eskom has, where they have a wheeled tariff and a non-wheeled tariff.
Yeah.
Over time. Agreed. Cool. Thank you. I think you're out of the firing line for the moment. Thank you, Shirley. Enriko,
thank you.
You're up. Thank you very much.
Cool. Thank you. Next slide, Jon. Okay, so I think the next few slides basically gives a bit more meat to Shirley's last slide, talking to expected or possible future changes after the current 2025 retail tariff plan approval. I think the first point we want to make here is possible further changes to the time of use classification. This slide shows sort of a future view on possible changes on the right-hand side, and then on the left-hand side, it shows the expected energy mix by 2035. If we look at the time of use classification, where the current approval reduced the morning peak from 3 to 2 hours and adding an hour in the evening, we expect that possibly to be replaced in future. And then also the period between 11 and 2 o'clock, possibly that will change from a standard sort of classification to off-peak. The reason for these reclassifications, if you look at the energy balance on the left-hand side, at 6 o'clock in the morning, given the decommissioning of the Eskom fleet, you possibly will not have enough electrons in the grid, especially assuming if not enough gas is available for peakers to supply the peak demand in that hour. And so possibly Eskom could introduce sort of that higher cost structure there to force volumes down. Secondly, if we look at the period between 11 and 2, you can clearly see in the energy mix the substantial increase in solar, almost like an oversupply of solar, with the excess solar being pushed into batteries, which then serves the evening peak. But even the oversupply of solar during that period, if you look at a sort of price volume curve, that should push prices down and then maybe reclassify that to a sort of off-peak classification. Clearly, the last one will have a significant effect on the possible savings you would have achieved if you look at the current wheeling project in terms of a lower tariff during that period. Next slide, please. So the next point talks to hourly versus monthly reconciliation. If you look at the current wheeling framework, wheeling credit gets reconciled on the basis of a monthly aggregation of generation and consumption. We've run this through a quick pilot little example, and on the left-hand side, you see two graphs there. The top graph gives you sort of the demand curve and then the generation curve with excess being shown each month. And then the bottom curve shows you sort of an average daily curve. You can clearly see that the generation goes beyond load a bit of excess. So if we do the reconciliation on a monthly basis, it shows 0% in the way that the mechanism works. If we run it on an hourly basis, it shows 9%. So clearly more punitive if it was a wheeling, sort of a wheeling project, and you would get less wheeling credits if the same mechanism applied. Just a note, and I think Shirley has mentioned this, at this stage, the impact of the market code on the bilaterals and how the recons work is not clear yet, but I think we can assume if everything goes hourly, that reconciliation from a wheeling code perspective will also go hourly. Thank you. Next slide.
So maybe Enriko, sorry, I could just touch on this.
Yep.
So we engaged with Eskom on the market code, and I think their view was it'll have to transform in some way there. They are conscious that there are already contracts that are signed on a monthly basis, but because of balancing and when the market is viewed, it is really up to the individual company or the regulated retailer or the party that acts as the market participant on behalf of the loads to take a view if they want to take that hourly versus monthly risk. And if they want to give a client a monthly recon and they're willing to take the hourly excess energy risk, you know, that will still be allowed in the market. But from what we can see, based on more PV and more wind all the same day, a brave market participant who takes that risk for large volumes. So I think that financial thing will also just push this hourly reconciliation in our view. Thank you.
Great, thanks for that, Rob. Okay, so if we look at possible further changes from a tariff perspective, we look at the legacy charts, and the graphs of the sort of diagram shown here is basically a proposed transition of the Central Purchasing Agency from the current WEPS prices if the market opens in April 2026. The idea is that all of the Eskom coal fleet individually will be selling power to the Central Purchasing Agency via vesting contracts, almost like a short-term PPA that gives certainty to price and volume. Those contracts will be open to market risk and gradually on a 20% per annum basis, to the extent that in April 31, those will have to trade into the market on a full competitive basis. The problem, as you all know, is that many of these plants may not be economically able to trade in a competitive market, especially given inefficiencies possibly or overcapitalization, as you would perhaps know what I'm referring to. So what then will happen if they can't trade on the open market? These will possibly remain on a sort of a long-term vesting contract selling energy, but that additional cost possibly will be added to the legacy charge, similar to the current REIPP, and which obviously, if that goes fixed, increase the fixed portion of the tariff structure. That's an important point. Also on this slide, just for the sake of interest, we've included a possible breakdown of the future tariff structure. It is essentially similar to the current approval for next year in the RTP 25, with the addition of possible distribution losses charges and transmission losses charges. And then in terms of energy sales, you'll have the option of wholesale market prices, which is almost similar to WEBs, but traded on the market, or regulated energy charges for captive customers that cannot participate in the market. For example, a municipality with any adequate grid capacity, that can't trade on the market. So, yeah, the next slide. So essentially what I try to show here is possible changes in the generator use of system charges, capacity charges, and network charges. Firstly, what we did is just to see the impact of 2025 approval now by NERSA on the capacity user system charge, and we see that it comes down from 4 cents to about 2.3 cents. One of the significant changes there is the removal of negative loss factors for transmission, basically bringing it up to 1. We think that Eskom, from a distribution point of view, will also amend that mechanism. At the moment, there's still negative losses charges, which are deducted from the generator user assistance charges, which might possibly increase that charge as well. But that said, if we look at the right-hand bottom, and I think Shirley has amended, referred to that from the cost structure currently, in the RTP 24 or 25 approval, Eskom indicated a fixed cost structure of 73% versus 27% variable. In contrast to that, the current tariff plan has got up to 90% variable cost recovery, and the rest is fixed. So clearly, I think in the long run, we may not achieve 73%, but at least there's a sort of a vision or a goal maybe for Eskom to increase the fixed charge components, possibly up to maybe 30% eventually. And obviously, as we've heard, there will be an unbundling for distribution, transmission, and generation. So we also see transmission and generation getting sort of possibly higher increases vis-a-vis maybe generation going forward. And we also fixed cost structures of those increases, going ahead. Next slide, please. I think, Shirley has mentioned this, the market will go to sort of an hourly reconciliation basis, and all generators and loads above 10 megawatt will become balance responsible parties. You will basically have to declare your day-ahead requirement for energy, and maybe the net energy if you've got a bilateral agreement, and there'll be settlement on that basis. But in the hour, if you're over and under, you'll have to pay for the fact that you have to buy energy if you're not balanced within a certain framework. And that ultimately will result in a possible profit or loss situation. And I think the bottom line to that is the need for derivative instruments or hedging mechanisms to sort of cover your downside risk if you go, if you trade on the market. That's all from my side. Next slide. Cool. Thank you.
So I think just a few comments and then we'll take the questions. So one is, I think the balancing market based on engagement of the market operator, the full impact financially of the balancing market, I think will change over time. And we might find that the actual impact is a small stick, but over time we think it will get to the marginal cost of generation. I think that is the view as we transition. So that's the one thing. There are a few other questions here. So one was around, do we think it's hourly or half hourly like Cape Town? My understanding is that most meters meter half hourly, but at the moment we believe it's all going to stack on hourly. Although based on analysis of client loads, there's significant difference between half hourly metering data and hourly. So you might eventually get there, but I don't think in my view that'll happen initially. It'll progress over time. I think some markets go down to 15 or 5 minutes from that point of view. Then there was a question around retail charges, and maybe Shirley, I'm going to throw that one to you. If you just could unpack what would be part of retail charges going into the future for us.
The retail charges, I mean, there's what Eskom refers to as retail as service and admin, but going into the future, the retail charges that we're referring here are going to be the charges that are regulated. So for example, the wires costs, the use of system charges, losses, all of those will be regulated because it's a natural monopoly. And then you will find on the energy side of it, distribution will also have to have regulated charges for the customers that don't participate in the market. So it's really referring to the retail space, Eskom distribution acting as a retailer, buying energy, and also as a distributor providing wires. Yeah, hopefully that.
Thank you. Cool. And then the last question is around the current RTP fixed versus variable. Is this a view of where Eskom's pushing for on the vesting contracts? And I think that is definitely the view we've heard. Eventually a 30% fixed component across all the tariffs is kind of the projected view. And that's based, I understand, Shirley, on the fact that ultimately that is Eskom's fixed cost base if you break it down. And this is supported in the cost of service study.
Well, I do want to mention distribution and transmission is largely fixed. So, you know, the wires, you don't remove a transformer because somebody's not using tomorrow. The issue around generation costs, in my opinion, Eskom could never go and ask for all generation fixed costs to be recovered through a fixed charge. That is just... then it's passing all the risk onto customers and not accepting their risk. So I don't think it'll ever go to, let's say, the 75% of generation costs being fixed, because even the Eskom even argues that the coal contracts are fixed. You know, the cost plus. I also don't believe the regulator would ever allow to go to very high fixed charges. Fixed charges are hugely unpopular everywhere around the world. I mean, Eskom struggled to motivate even the network charges to be more fixed. Thanks.
Cool. Okay, thank you. Then I think we're going to pass on to the most interesting part of the discussion, which is Jon, you working us through Excel. Thank you.
That is correct, Rob. Let me just quickly bring up my screen again. All right, so first I'm going to take you guys through just on the high level the Eskom model calculator and how that's set up. So the model is set up to calculate costs of wheeling and offset for buyers of energy under the Megaflex, Miniflex, Ruraflex structures. So you can sort of select those structures over here. Also calculates generator use system charges, generator use of system charges for generators, but that's not our focus for today. In the main inputs and comparison section, that's where we're on now, it drives your major assumptions in the model. We first have our adjustment section for type of transaction, for instance, wheeling, offset, or generator purchase. We're going to stick to wheeling today. And then tariff structure, we're sticking to Megaflex. And then you input your voltage, transmission zone, etc., relevant assumptions of the load. And then there's an input section for your notified maximum demand. You plug that in, and then you've actually got an option for hourly data, which we recommend. It'll give you produce more accurate results in the model. You can switch this off, but this will require you to enter sort of arbitrary peak, standard, off-peak ratios, which will sort of probably not give you the most accurate solution there. So on the hourly data, just to jump to the hourly data input section, just zoom in here. In this section, you would plug in your load on an hourly basis. You'd plug in your reactive power profile if you have that on hand, and then your generator load profile on generator profile on an hourly basis. This then, based on the reactive power, your apparent power is actually calculated, but the model doesn't calculate your reactive energy charge as it stands. And then if you move back to, once all the inputs are done, when you move back to the main inputs and comparison section, you've got all your assumptions plugged in, and you can move down to, you'll see there's a summary of your energy from on a load and generator basis, and then your load charges as based on the assumptions you selected. So this is the Megaflex tariff, non-municipal tariff structure. And then at the bottom here, we can actually look at a side-by-side of our pre and post generator profile impact on our cost of energy. So you could look at your savings there, post the wheeling credit, calculate it in the model, and then you've got a little 2-3% savings at a point in time, or on a 1 year savings basis, right? So the model has its limitations. While it's sort of reliable with regards to basic savings calculations, it's not currently set up for the update in the retail tariff plan, and excludes charges such as the legacy charge, generation capacity charge, and as mentioned, reactive energy charge is not added to this summary. And then it's not set up for on-site projects, so you can sort of only do wheeling in this case, and it does not take into account your IPP or trader aggregator energy cost, which you might be paying from a buyer perspective. It does not allow for comparison of scenarios as well, so we sort of can't do any scenarios in terms of the changes in the RTP, and the energy is reconciled on a monthly basis, which is the current consensus, but it only allows you to do that. All right, so I'm going to quickly skip to something that Cresco has been working on. So we've been doing a lot of work for our clients to calculate sort of impact on the changes. Hold on a sec. Quickly on so you could get to that. I think. Can I open this up? All right. So jumping into the Cresco, we built a tool to sort of be able to compare different tariff structures, compare different scenarios under change in the tariff structure, and then also set up some sort of our own views on where we think the tariff structures will go to in terms of fixed variable, as Enriko mentioned and Shirley mentioned, in terms of time of use, how we see that moving, the schedules moving, and then building in the approval from NERSA on the latest RTP submission. What this tool does is an output section, so you sort of can see like there's a lot of data produced under each of these sort of the scenarios that you build. There's a scenario section where you can sort of add in all different tariff scenarios, your loads, your generation profiles, your different tariff structures. You can build out your different tariff structures and compare them, and then add your generation profiles. And as you can see here, there's your IPP cost also included. So if you have a tariff at a sort of on a rand per kilowatt hour basis, you can add that in, and that is taken into account for these savings. This model also allows you to move between wheeling and on-site projects. Right. Does also allow you to calculate a break-even tariff on your project. Savings are calculated on an overall project basis or a 1 year basis, and you can then calculate a break-even tariff on a project nominal basis or a year one basis. Now, produced from this model, I just want to head back to the presentation. Produced from this model, we have a couple of sort of scenarios that we can sort of show, where we show the impact of savings under the retail tariff plan. The current retail tariff plan, the assumptions that are, this is post the NERSA approval of the changes that Enriko and Shirley have mentioned in the previous slides. I'm not going to go into too much detail, but just to show the impact of savings based on our assumptions and the bringing in the fixed charges or increasing fixed charges versus our variable and the schedules that were mentioned previously. We actually see under the current NERSA approval of the retail tariff plan, with our 20% fixed generation capacity charge coming in, the legacy charge coming into play, and our new proposed time of use schedules, as well as the ratios. On a wheeling basis, we also know that affordability subsidy is not included in the wheeling credit. We see a loss in savings in this scenario, which is a wheeling wind profile with a low load factor. So again, very specific to the project. We see an 18% loss in savings under this scenario, and then we've actually set up a post-27 view from Cresco's perspective. And in this perspective, we've plugged in the full generation capacity charge, that sort of a long-term view, that Eskom will be getting that in the future, and energy profiles being reconciled on an hourly basis. And that has a major impact on your excess energy. And that excess energy cost is around 11% for this scenario, and your savings drop by about 49%, taking into account all your factors, IPP cost, etc. as well. And you can see here that on an overall basis of fixed costs to variable costs for the specific profile is at 22%. So there's quite a major impact in terms of what could happen in the future in terms of considering all these factors: hourly recon, fixed variable charges, and the schedules. I think.
Yeah. So thanks, John. That was good. So I think that the point is, well, we've run on-site wheeling, high load factor, low load factor. Tell us a bit about some of the scenarios at a high level. I mean, I think it is very bespoke to the generation profile and the client voltage connection and everything, because the numbers bounce all over the place.
Correct, yeah. So high load, low load, significant effect in terms of the fixed charges. So low load, your fixed charges will have a bigger impact on your savings due to your high NMD and your lower sort of energy output, and the savings on the variable charge. It is on a like-for-like basis. You definitely consider that on a like-for-like basis. And wind profiles against solar profiles are very different.
Cool. Thank you, John. We've actually made up some time, so we'll take. There's a few questions here. So the one is the latest calculator on the Eskom website the latest one? To be honest, you have to ask Eskom that question. We've just used the one that we had previously, but as we mentioned, we've built on it. The Eskom calculator also doesn't consider on-site projects, so it's only one side of the story. And there was a question around if you're front of the meter and batteries are charging from the grid, are you expected to be the same as a normal load? And my understanding is, and perhaps Shirley, you can jump in here, is that they would be considered a normal load if they're a private sector deal. If they're obviously part of the REIT deal, it is a different approach. But I would think that over time there might be some incentives given to support that, especially if they were providing ancillary service support to the grid. So you might find that perhaps reducing the NMD might incentivize these BESS projects, especially if their capacity is not being utilized that highly. But Shirley, I don't know if you have a comment on that, if you believe that.
Well, what I can say is, if you do have batteries, and because of your batteries you are managing to reduce your NMDs, then you will get a benefit. You'll pay a lower generation capacity charge, you'll pay lower network charges, and so on. Just on the Eskom calculator, I just want to say, I think what is on the Eskom website is two things. One is just the normal sort of the one that John just shared. And then there's another one that does a comparison between the tariff plan and the rates. Those will all need to be updated once Eskom's new tariffs. So whatever's on there now is still based on 24-25 numbers and what Eskom submitted in the tariff plan. That's still going to have to change. That's going to have to change, yeah.
Thank you.
And can I just make one more comment around James's question around the 70%? The 70% is Eskom's costs, not tariffs. Eskom is arguing that at least 70% of its costs are fixed, but only recovering 10% through fixed charges.
I wish you just read our client slides correctly, hey, James? Just joking. Cool. So yeah, to confirm, the slides will be shared. Thank you very much, everyone. It's 1 o'clock. I think the rest of us have to do our next team speed date. So appreciate all your time, and hope you can join us in March for the one on carbon of the JSE. Appreciate it. Thank you.